A teacher making $55,000 a year pays a higher tax rate than some of the richest people on the planet. That's not a conspiracy theory. It's public record. In 2021, ProPublica obtained more than 15 years of tax returns from the wealthiest Americans, and the numbers were staggering. From 2014 to 2018, the 25 richest people in the U.S. saw their combined net worth grow by $401 billion. Over that same stretch, they paid a combined $13.6 billion in federal income tax. Do the math, and that's a true tax rate of about 3.4%. To put $401 billion in context, that's larger than the annual GDP of countries like Portugal or New Zealand. It's not a rounding error. It's the entire economic output of a country, growing essentially tax-free for half a decade. Individually, it gets even more extreme. Warren Buffett's true tax rate over those years was about 0.1%. Jeff Bezos paid roughly 0.98%. Michael Bloomberg came in around 1.3%. For comparison, a median American household pays somewhere around 14% of its income in federal tax. Nobody here broke the law. Every single dollar of this was completely, boringly legal, which is exactly why it's worth the next 12 minutes. Not to be outraged, but to actually understand the rules, because a few of them in miniature are available to you too. So, today, every major legal mechanism the ultra-rich use to shrink their tax bill explained in plain English, plus the smaller-scale versions a regular person can actually use. The U.S. tax code was never built as one single system. It's really two systems stapled together, one for income you earn and one for wealth you already hold. Congress has spent nearly a century writing incentives into that second system. Incentives to invest, to hold long-term, to pass a business to your kids, to give to charity. Those incentives were mostly well-intentioned. Rule 1 of that second system: it taxes income, not wealth. Earn a salary, and the IRS takes a bite every single paycheck automatically before you even see the money. But if your net worth grows because your stock portfolio went up, that's called an unrealized gain. And unrealized gains aren't taxed at all, ever, until you sell. So the first move of the ultra-wealthy is almost embarrassingly simple. Stop earning a salary and let your net worth grow instead. Warren Buffett has paid himself a $100,000 salary for over 3 decades. Plenty of other billionaire founders and CEOs take $1 a year in salary and get effectively everything else in stock. On paper, their income looks tiny. Their wealth, meanwhile, is compounding completely but eventually untaxed. You need actual cash to live on. Private jets and beach houses don't accept stock certificates. This is where it gets clever. Instead of selling stock, which would trigger capital gains tax, you borrow against it. Private banks compete for the business of the ultra-wealthy, specifically to offer what's called a securities-based line of credit, a loan using your stock portfolio as collateral, often at interest rates lower than a mortgage. Borrowed money isn't income, so it isn't taxed. You can spend it exactly like a paycheck without it ever appearing on a tax return. Financial planners have a name for this whole strategy: buy, borrow, die. Buy appreciating assets. Borrow against them tax-free to fund your entire lifestyle, your philanthropy, even your next round of investments. Never sell, never trigger tax. Then, when you die, your heirs inherit those assets at their current market value, not what you originally paid for them. It's called a step-up in basis, and it can erase decades of gains overnight, instantly, on paper. Say you bought stock for $1 million decades ago and it's worth $50 million the day you die. Sell it yourself, and you'd owe tax on $49 million of gains. But your heirs inherit it already valued at $50 million, so if they turn around and sell immediately, their taxable gain is close to zero. That $49 million in growth simply vanishes from the tax system. Combined with the loans from the last section, which also die with you, often settled by the estate rather than ever being repaid with taxed income. This is how entire fortunes pass from generation to generation with a tax bill that rounds to almost nothing. And step up in basis is just the entry-level version. Serious estate planning goes further, using tools like the Grantor Retained Annuity Trust, or GRAT. Simplified version. You place a fast-growing asset into a trust and take back annuity payments roughly equal to what you put in over a set number of years at a modest IRS-assumed interest rate. If the asset grows faster than that assumed rate, which for a hot stock, it often does, all of that excess growth passes to your heirs completely free of gift or estate tax. Do this repeatedly on rolling short terms, and it's sometimes called zeroing out, a guarantee, a technique that public estate planning literature ties to many billions of dollars moved across generations of a handful of ultra-wealthy families with essentially no transfer tax at all. Add a generation-skipping trust to the mix, designed specifically to jump money past your children directly to your grandchildren, and a family can use the same lifetime exemption to shield transfers across 2 generations for the tax cost of shielding 1. Combine trusts, step up in basis, and buy, borrow, die, and you get a genuinely wild outcome. Capital that is never earned as ordinary income, never sold to trigger a gain, and never taxed on the way to the next generation. Even when the wealthy do eventually sell something and pay tax, they're often paying less than you'd assume, because the tax code taxes investment income at a lower rate than salary income, by design. Hold an investment over a year and sell it for a profit, and the top federal long-term capital gains rate is 20%. Earn that same amount from a job, and the top marginal income tax rate is 37%. That gap used to be even more dramatic. For stretches of the 1980s and 90s, ordinary income tax rates for top earners were considerably higher than they are now, while long-term capital gains have stayed comparatively low for decades. This isn't a loophole exactly. It's just the base architecture of the tax code. But it means a hedge fund manager living almost entirely off investment gains is very often taxed more gently than the analyst working for them on salary. Speaking of hedge funds, here's a specific rule that gets an outsized amount of political attention. Private equity and hedge fund managers get paid a performance fee, typically 20% of the fund's profits, called carried interest. Under current rules, that fee can be taxed at the lower capital gains rate instead of as ordinary income, even though, functionally, it's compensation for managing other people's money. It's one of the most debated provisions in the entire tax code. Multiple presidents from both parties, going back over a decade, have proposed closing it. The 2022 Inflation Reduction Act did tighten it slightly, extending the required holding period, but the core mechanism survived intact. It remains one of the clearest examples in the tax code of labor income being taxed as if it were investment income. Real estate investors have their own dedicated playbook. Sell an investment property at a profit, and you'd normally owe capital gains tax on the sale. But under what's called a 1031 exchange, named for the tax code section that created it, if you roll the proceeds into another like-kind investment property within a strict timeline, you can defer that tax indefinitely. Do this enough times across a career, and combined with step-up in basis at death, the deferred tax can vanish completely rather than ever actually being paid. There's also opportunity zones, created by the 2017 Tax Cuts and Jobs Act, a program that lets investors defer, reduce, and in some cases fully eliminate capital gains tax by funding development in designated lower-income areas, with the biggest benefits reserved for money left invested the longest. 2 more mechanisms worth knowing, because they're less famous but genuinely significant. First, qualified small business stock, under Tax Code Section 1202. If you're an early employee, founder, or investor in a qualifying small company, and you hold the stock at least 5 years, you can potentially exclude up to $10 million, or 10 times your original investment, whichever is greater, of capital gains from federal tax entirely. It's a huge reason early startup equity is treated so differently from a public company salary. Second, much older, municipal bonds. Interest earned on most state and local government bonds is exempt from federal income tax, and often from state tax too if you live in the issuing state. It's a lower-yielding investment than the stock market, but for someone already sitting at the top tax bracket, the tax-free yield can be worth more after tax than a higher taxable one. Even charity gets optimized. Instead of donating cash, the wealthy typically donate appreciated stock directly to a donor-advised fund. They get the full tax deduction today, calculated on the stock's current market value. But the fund itself can sit on that money for years, even decades, before actually distributing it to any real charity. And because the stock was donated rather than sold, no capital gains tax is ever paid on the growth either. Some families go a step further with a private foundation, a more involved but similarly structured vehicle that can also employ family members.